Hi, I'm Chumbeng. Together with me is Jupan. We are from mykayaplus. This is our second video. Today we will be discussing the viewpoint analysis. So what is viewpoint analysis? Maybe Jupan, you can start it off with the definition.
Sure. Hi everyone. So viewpoint analysis actually is the breakdown of the return of equity into three subcategories. Basically, it zooms down to analyze the profit margin, the assets turnover, and also the financial leverage. So if you can see there in the formula, you have your net profit over sales and multiply with the sales over the total assets. And after that, you multiply it again with the total assets over the equity.
Yup. So we will get the return of equity if we multiply all three items together, which eventually will become the net profit over the shareholder equity. But you might be asking us, why do we need to zoom into so details? Isn't it the high ROE is a straightforward sign that a company is a good company to invest in?
Not necessarily though. The ROE and the viewpoint analysis should be used as tools to analyze a company, not as a key decision-making point. So you all shouldn't be making any investing decisions just purely based on a company's high ROE.
Yep. So if you take a look on this slide, just imagine if you are the owner of this cafe. Viewpoint analysis is actually one of the best ways to measure your business performance easily. So the first aspect is the profit margin. You should check how much are you earning per item served. Second, what is the daily average occupancy of your cafe space? Is it always full? Or is it your chair, your space or the table are well utilized? This will correlate to your asset turnover. Lastly, is about financial leverage. Whether your cafe is taking loans or borrowing to expand or scale your business strategically. Okay, Jupan, maybe we should come out with some example to show our viewers. Maybe it's a good idea to use a mama store as an example because I'm really missing the time where I can enjoy my supper at mama store. But now it's the lockdown period, I cannot go out.
Okay, sure. Alright, here is an example of three mama stores. Do a viewpoint analysis on them. So let's compare two mama restaurants to show how a viewpoint analysis can differentiate the two companies' respective performance. So we have two sample restaurants, original Penang Kayu Nasi Kandar and also Nasi Kandar Pelita.
Yup, from the slide you can see both mama store are having the same annual sales amount of 2 million. However, Kayu is having a higher ROE. So the direct assumption that most of the people will make is the one with higher ROE is a better company, right?
By looking at the ROE itself purely, yes. But when you look into the financial leverage, you see that Pelita has a higher equity, while Kayu has a higher gearing ratio due to lower equity.
Yes, in another word, Kayu has more liability if compared to Pelita.
Yes, you are right. Since assets equals to liabilities plus equities, we have to look deeper to check whether the liabilities of Kayu is made up of payables or borrowings.
Yes, just imagine Kayu take loans to grow their business, then they will be heavily impacted during a lockdown time like this. Hence, when we do company analysis, we have to ensure that company have enough liquidity to pay off their liability before investing.
Yes, spot on. So imagine if you didn't check the liabilities of Kayu and you invested in this company purely based on the high ROE. And during difficult times like this, the company may face cash flow problems. Sales will definitely be impacted, but they still have to pay bills and also worker salaries.
Yes, it can become very scary if it happened to a listed company. So for example, there was one company called Sapura Energy Berhad. They used to face liquidity issue until they have to make a cash call by diluting the outstanding share. This action itself made their share price become cheaper because when there are more share in the market, the supplies go up while the demand remains the same. Of course, the share price will drop. So as a result, when investors saw a huge drop in share price, it will trigger another action, which is panic selling and cause the share price to drop further. Can you imagine a company like Sapura that used to trade at 4 can go down to 7 cents because of all these things?
Yes, that's a very good scary example on why we should always check the gearing of a company before we invest in it. Another reason why DuPont analysis is very useful is to compare companies that have the same ROE. We can drill down further to single out which of the companies is actually better by just doing the DuPont analysis.
Yes. So now we have another mama together with Kayu. Another mama is called SS2 Muni. So you can see both of them are having the same ROE, which is 50%. But you can see the profit margin from Muni is actually much higher. The simple term is Muni can earn more than Kayu by selling the same amount of roti canai.
Yes, you are right. Not only that, you can also notice that Muni is also able to generate more revenue per asset. It can generate 25% more with the same amount of assets if you compare SS2 Muni's asset turnover versus original Penang Kayu.
Yep, and look, Muni has no liability as their asset is equal to equity. But of course, this can't be real in actual world, where in the world of business don't have borrowing or payables.
Yes, we are using a fictional company as example, but you are right. Muni can generate higher profits. It can also generate more sales with the same amount of assets. So it has the higher potential to grow at a faster rate when they eventually try to take in some borrowing to further grow the business. So even though Penang Kayu and SS2 Muni both have the same ROE, I would definitely think that SS2 Muni is the better company just by doing this DuPont analysis.
Yes. So next time when you look at the ROE of the company, remember to always break it down into 3 aspects so that you can have a better picture of the company. Remember, every aspect matters. An ideal company that will give a high returns is either they are having a very high profit margin or they are having a high asset turnover, and also depends on whether they are leveraging on financing as well.
Yep, you are right. Absolutely correct. And we hope we share something that is useful to you. Please give us your feedback, or do you have any questions? Let us know in the comment section, or even what are the next topics to talk about in our upcoming video.
Yes, don't forget to like and subscribe, yeah? And if you haven't checked out our first video on tricks to justify high PE ratio stock, you may click here to check it out. So I think that's all for today. We will be checking out. Bye.
Bye-bye.